Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. This is episode 54. So, you've just successfully completed your first real estate deal. Maybe it's a flip like we talked about back in episode 48. Or you've sold a rental property after a few years. You're looking at what seems like a nice profit on paper, ready to celebrate that win. Then tax season hits, and bam, a huge chunk of that hard-earned profit vanishes, heading straight to Uncle Sam. That's a painful surprise many investors experience, and one we want to help you avoid. Today, we're diving into a topic that might not sound glamorous, but is absolutely critical to your bottom line. Understanding and planning for the tax implications of your real estate investments. We'll break down why tax planning matters more than you might think, highlight common areas where investors stumble, and give you a practical playbook to help you keep more of your money working for you. Let's get strategic about taxes. Let's start with a crucial reality check. Taxes aren't just a minor administrative detail in real estate. They are a major factor that can dramatically impact your actual net profits if you're not proactive. When you sell an investment property for a gain, you're generally looking at capital gains taxes, and the rates can vary significantly. If you hold a property for 1 year or less before selling, any profit is typically considered a short-term capital gain. For the 2025 tax year, these gains are taxed at your ordinary income tax rates, which, depending on your income bracket, can range anywhere from 10% all the way up to 37%. That can be a substantial portion of your profit. However, if you hold that same property for more than 1 year, the profit generally qualifies for long-term capital gains rates. These are usually much more favorable, typically ranging from 0%, 15% to 20% for most investors, again, depending on your taxable income. The difference is huge. Imagine making a $50,000 profit. As a short-term gain, if you're in a 24% or 32% ordinary income bracket, you could owe $12,000 or even $16,000 in federal taxes alone. If that same $50,000 profit qualified for a 15% long-term capital gains rate, your tax bill drops to $7,500. That's a massive difference just based on your holding period. And we haven't even touched on state taxes or the potential 3.8% net investment income tax for higher earners. It's a common challenge for new investors and small business owners to underestimate their tax liabilities. And the IRS is serious about compliance. Every year, they assess billions in additional taxes and penalties due to errors, underreporting, or late filings. Understanding the tax consequences right from the beginning is a critical part of your preparation phase, something we emphasized back in episode 15. It's clear that taxes can take a big bite, so where do investors, particularly those newer to the game, tend to make mistakes when it comes to their real estate tax obligations? There are several common areas where investors, especially when they're starting out, can get tripped up by taxes. First, as we just highlighted, is misunderstanding or mismanaging holding periods. Many investors eager to lock in profits from a flip might sell just shy of that critical 1-year mark, unknowingly subjecting themselves to much higher short-term capital gains rates. That decision on when to sell, a key part of your exit strategy from episode 50, has major tax implications. Second, a huge one is missing out on legitimate deductions. Real estate investing offers a fantastic array of potential tax deductions that can significantly reduce your taxable income. Third is the risk of DIY tax preparation errors. While tax software has come a long way, the U.S. tax code, particularly concerning real estate investments with elements like depreciation recapture, passive activity loss limitations like the $25,000 allowance for active participants with modified adjusted gross income under $100,000, which phases out by $150,000, and understanding the nuances between repairs versus capital improvements is incredibly complex. Okay, those are some significant potential traps. So let's shift to the solutions. How do you build a smart, proactive tax strategy to protect your hard-earned profits? Here's your playbook for navigating the tax landscape more effectively and keeping more of what you earn. And a quick disclaimer here. I'm not a tax advisor, so always consult with a qualified CPA for advice tailored to your specific situation. But these are key areas to discuss with them. Step 1, Plan your holding strategy with taxes as a key factor. From the moment you're doing your deal analysis, think about the tax implications. If it's a potential flip, understand the profit difference between selling in 10 months versus 13 months. Sometimes a slightly longer hold to achieve long-term capital gains rates can significantly boost your net return. Step 2, become a master of meticulous record keeping. This is absolutely non-negotiable for any serious investor. Keep detailed, organized records of every single income transaction and every single expense related to your investment properties. This means all receipts, invoices, bank statements, credit card statements, clearly identifying property expenses, mileage logs for property-related travel, and, of course, all your closing documents for purchases and sales. Good records are your best friend if the IRS comes knocking, and they are essential to ensure you or your CPA can claim every legitimate deduction. Consider using accounting software designed for investors like Stessa or REI Hub, or even general business software like QuickBooks to make this much more manageable. Step 3, assemble your A-team, including a real estate savvy CPA. This is a critical investment, not an expense. Don't just go to any tax preparer. Find a certified public accountant or enrolled agent who specializes in real estate and works with investors. They understand the specific deductions, depreciation rules, the difference between dealer and investor status, and strategies like cost segregation studies or the nuances of the $25,000 passive loss allowance. Their advice can often save you far more than their fees. Step 4, understand and explore tax deferral strategies when appropriate. For investors looking to grow their portfolio over the long term, strategies like the 1031 exchange can be incredibly powerful. Essentially, a 1031 exchange allows you to sell one investment property and defer paying capital gains taxes if you reinvest those proceeds into another like-kind investment property within very specific IRS timelines and rules. It's a complex transaction that requires expert guidance, usually from a qualified intermediary and your CPA, but it's a cornerstone strategy for building significant real estate wealth by keeping your capital working for you tax-deferred. Okay, here's your challenge today. If you currently own investment real estate, take 15 minutes this week to review your record-keeping system for just one of your properties. Are your expense records truly organized and complete? Are you confident you captured every potential deduction for that property last year? If you're planning a property sale soon, quickly estimate the tax difference if you sold it as a short-term gain versus a long-term gain. This awareness is the first step towards smarter tax planning. And as always, if this episode provided some valuable insights and maybe a bit of a wake-up call, please subscribe to the 5-Minute Prime podcast, share it with another investor who could benefit from better tax planning, and leave us that review. You can find more resources at reiprime.com.